Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike.
Mike Zlatnik. And today it is my pleasure and a privilege to welcome Ray Mazzie. Am I pronouncing your name correctly, Ray?
Yeah, well done.
Okay. So Ray, thank you for coming on a podcast. You were introduced by a mutual friend, and Ray is a managing director at the Southern Waters Capital based in Fort Lauderdale, Florida, and he focuses his time and energy on sourcing deals. Ray has graduated from the Florida State University, has an MBA, as well as a dual degree in economics, political science. He's a licensed attorney in Florida, and he was a former gubernatorial fellow for Governor Rick Scott. Welcome to the show.
Yeah, no, thanks for having me. I appreciate it.
Tell us a little bit about Ray, your family, kids, cats, pets, whatever works for you.
Yeah, no, not much to me, but not married. I do have a lovely dog, Molly. I've had her. She's almost 11 now, which is kind of crazy. Kind of helps remind me how old and young I am. So I got her when I was a freshman in college, but so it's been a little while since then. But obviously, most of the people I deal with in this business have put in a few years past me, so they call me young, and I feel old every time I look at my dog. But other than that, honestly, real estate's the thing that I love most to do. I guess I would say I love to ski as well. But as far as hobbies, I find what I do to be the most fun thing that I can be using my time on. So it's honestly looking for real estate. And if I'm not doing that, I'm usually spending time talking about it with friends and business partners.
Very cool. So you have a passion to real estate. Well, let's jump straight into what does Southern Waters Capital invest in?
Yeah. No problem. So basically, you can consider us at this point land developers who also partner up with other private equity shops or large developers to then take projects vertical. But we're happy to get into projects a lot earlier than most people are. We're happy to take on entitlement risk and things of that nature. Me and my business partner are attorneys by education. We certainly have no business practicing law, but we know enough to be dangerous, as they say, when it comes to entitlements and positioning parcels for future development. And in addition to that, you mentioned we do lending and things of that nature. We actually used to do that. We haven't put out any loans or anything like that in a while. We started out as a credit strategy. We were investing in securities in the beginning, and then we quickly learned there's a lot of value capture that can be captured when you are essentially arbitraging, Main Street sellers with Wall Street buyers, and forcing appreciation through entitlements and positioning deals or positioning projects and sites for future deals with much larger firms, that have a bigger vision. So we noticed that, and we quickly shifted our firm from securities investing to pretty much solely real estate development now. We're just over 1,700 units in our past 2.5 years of running at this. It's been a pretty quick growth, but at the same time, we're excited about what's to come, and we definitely have a lot more work to do.
Well, that's a lot of growth. 1,700 units in a few years. That's a lot of growth. And we're recording this in late February 2023. So I'm just curious, how is your strategy changing given where the market is going? There seems to be, we've seen fast and furious interest rate increases, which obviously impact development substantially. Cost of capital, obviously cap rates. Just curious, what are you seeing you're in Florida, which is recession in Florida, people are saying it's not possible nowadays. Everybody's moving to Florida. So from that perspective,
it's definitely possible. Yeah, no, not to cut you short, but I think I know where we're going with this. It's definitely we'll give it the credit that Florida is a more resilient market as of today. We can't say that that's going to be the case going into the future. I like to believe it is. I'm an internal optimist. You have to be as a developer, but at the same time, my business partner is a 30-year veteran of Wall Street. He was on the bond trading side, so nothing can get past par for him. So he's a optimistically pessimistic, if you will. He knows not to get too excited about anything good or bad. But to answer your question directly, what have we done to change our strategy? Absolutely nothing. We've always been a firm basically focused on basis and location, and I think the only places of shelter in today's market right now are having a strong basis, having a good location, and honestly, having a really strong balance sheet. Those are the three things that are going to protect you in volatile markets, especially like the ones we're experiencing now. And, if you have staying power and you get into an asset at a great price and you believe in the location, and maybe right now is not the best time to build, but maybe 6, 12, 18, 24 months down the road might be a better time to build. Then you just have to make sure that you're putting your projects in a position where they won't be squeezed over time. And usually, I don't like to make the pitch that, you should bet on appreciation and inflation and all that. But, if you buy your land at a good price and you wait 2 or 3 years, it's usually a pretty rare scenario, especially in the state of Florida, where you go back to the market and your land is worth significantly less. Now, if you're an out-of-state buyer and you came in way too high in the first place, you're stuck in a different position than my firm is. And essentially, that's what we do and what we focus on in our strategy has always been focused on rental housing. We're product type agnostic. We'll build, build to rent, whether that's casitas, cottages, attached townhomes, detached single family. We'll do multifamily, whether it's low rise, garden style, mid rise, or urban. Really, for us, it's yield on cost, unit economics, and risk, and just making sure that we're putting together a project that we think is, putting a square peg in a square hole, not putting a square peg in a round hole. And that's just kind of how we approach development and approach our business.
Yeah, I appreciate that color, and it makes sense. You're investing on a fundamental basis, and you mentioned a couple of great points on the staying power, especially when there's uncertainty in today's environment. But if you bought right, for sure, the assets have long-term value. But are you buying mostly? You're in Fort Lauderdale. Is it mostly Miami projects, or are you actually going into other areas? Built to rent. I've heard. I have actually a good friend whose company was just acquired, and they do a lot of built to rent in Florida, actually, northern part of Florida. Yeah. But what's amazing, that strategy works, but he's not in Miami area. He's in Jacksonville, and they're in Ocala. They've done a number of other sub markets. So just curious, where are you doing your projects? Are they Miami area or the Central Florida, Northern Florida?
Yeah, well, like I mentioned, we're happy to do different types of products. So when it comes to our garden style and our build to rent, like you alluded to, it actually is in what we call the golden triangle of Florida. But yeah, we're in Ocala, Wildwood, Cocoa, areas like that, where you have fundamental imbalances in supply and demand with strong history of rent growth in the past 5 years. And, job growth is strong as well. Schools are good, if not good, then decent, no C schools or anything like that, but high B's and A's. And it's all the traditional things. So yeah, our less dense, more suburban product is definitely not happening down here in Southeast Florida. Now, I'm sure there's people listening who are working on stuff in Southeast Florida, and I'm sure it's possible and all that. But to us, we just think the most value is in Central Florida right now, really kind of from Ocala south to like the top of Lake Okeechobee, that kind of band. Now, I'm sure, again, there's people who love Southwest Florida, people who love Southeast Florida, people who love Northeast Florida, and I think all those markets are great, and all those markets can actually, support good projects. I just think it's a lot easier to operate in the Central Florida area based off of basically connectivity, job growth, supply constraints, and we think pricing on land is just much more advantageous there. And at the end of the day, that the only two things you can't change are where your project is and what you originally paid for it. So we just make sure that we're putting ourselves in a position where we have the most room to make mistakes, to be completely honest with you. And that's why you buy dirt at a good price. And anyway, long way of saying you're right. The best build to rent markets, or in my opinion, the best build to rent markets and suburban garden style markets or low rise markets are those, tertiary, secondary Orlando markets, or tertiary, secondary Tampa markets, all the way over to Daytona and stuff like that. Although I haven't found a good project over there yet, I see a lot of potential on the East Coast.
Yeah, that's a great explanation. Really appreciate it. I guess it's an I-4 corridor, right? That corridor.
Yeah, the reason I don't say that is because technically people like know Orlando if people don't know Orlando, everything's in Orlando. Like if you actually don't, because Orlando is a massive city. If you look at it on a map, and a city in air quotes, like if you look at the Orlando Economic Partnership, which is like the development corporation nonprofit that sits over a lot of Orlando's growth, like it's just a huge area, a massive area. And whenever you say the I-4 corridor, if you went 25 miles north and 25 miles south, you'd be missing so much of what I'm talking about. So that's why I like to widen that band. But you're totally right. It is, to us, it's the I-4 corridor, and we know what we're talking about when it comes to that. But I feel like if I don't explain that I'm willing to go up to Ocala and down to Lake O, then people don't realize how much more land mass there is to take advantage of. But not to correct you, I just want to make sure that people know the I-4 corridor is too skinny, in my opinion. It needs to be a much bigger belt. I-4 belt.
Yeah, I really appreciate the clarification. It makes a lot of sense. And again, Florida is seeing a lot of inbound migration. Not everybody is moving to Miami or Tampa. There's a lot of job creation in sort of the wide I-4 corridor, as you said. You're trying to build where the jobs are going, where folks are moving in. So from that perspective makes a lot of sense.
We keep it super simple here. I mean, when it comes to location and everything, it's just looking at the main veins of Florida, right? Like we said, I-4, look at I-75, look at the turnpike, look at all the expressways, follow the bright line. It's things like that are just natural paths of growth. You simply, you need that type of infrastructure for a big deal to happen. You can't be going down a 2-lane road or anything like that.
Yeah, understood. Makes sense. Transportation is a critical component in any path of progress per se. So, do you have a fund? How folks invest with you in this strategy? I'm just curious. Is it something that you have private investors? You have a fund? It's obviously at this point, a little turbulent times, but land investing has been fundamental part of the American dream. So.
Yeah, we just so a little bit of both. We just actually got our first public-private partnership that we'll be announcing soon. I assume by the time this is launched, we'll have already announced it. But either way, that'll be probably the first opportunity for the public to invest in our deals. When I say public, the general public, people that we're maybe not as close to. Otherwise, we really pursue our projects in a more bespoke way, as brokers would say. But what we do is pursue the projects with our own capital to get them positioned. And then once they're positioned, we usually get together with a private equity group or a family office group or a developer that's large enough to essentially take on the project without any partners if they had to. So really, it's instead of having, I won't say they're institutional investors, but they're institutional quality with more of a family office feel, and they're more JV partners. So we bring those groups on, and then we'll together either go to the LP markets or fund the deal in a different manner internally. But that's how we approach it. And so the short answer is retail, high net worth, or public money hasn't really been something we've tapped into. We know that it's a great market. There's tons of capital out there, and anyway, it's just a different type of investor, and it's somebody that we want to get more acquainted with. We just want to make sure that we're prepared for that in just a back office manner, just handling that many people as opposed to having one or two groups, having 10, 15, 20, 30, who knows, more investors. You want to be able to make sure you can appropriately and adequately answer all their questions and all that. And anyway, it's a long way of saying no to retail at the moment, but I think the opportunity to do so will open up shortly, and we're looking forward to doing it in the right way.
Yeah, Ray, I appreciate that. Fewer bigger checks, more programmatic sources of capital is a lot easier to deal with than trying to deal with retail investors. So no argument with that at all. It is a you just want to do your business, you want to do what you do, and get the capital available when you need it. And it makes sense that you actually do the land acquisitions with your own capital. I assume you take it through the entitlement process, and then when you're about to go vertical, that's when you look for capital.
Yeah, definitely. We'll do it a little differently from a lot of groups. Some people like to bring sites to shovel ready. I don't want to give away any secret sauce, but to me, it seems to be a little dangerous. Honestly, it gives the potential investor the opportunity to beat up your site design and then eventually your purchase price. So, or their investment purchase price, I should say. But so anyway, we get things to what I call site plan ready instead of shovel ready. I basically bring a blank canvas to my JV partner and we say, hey, let's paint something together, and we'll pursue it together from there. So that's how we do it. But yeah, the entitlement risk at that point is next to nil, so long as you've done your DD the right way and you have all the technical suitability like capacity and concurrency and all those types of things. What I say is once the votes are out of the way, you know what I mean? And you know what you're doing and you have good engineers and architects, you should know what's going on that site. So that's it. That's how we do it. But yeah, I think it's worked out a lot better that way as opposed to trying to bring some shovel ready site to somebody and demanding that they build what you designed.
Yeah, I got you. So what do you see strategically, multi-year vision? Is this built to rent strategy, garden style apartment complexes, going to continue to grow at a strong pace in Florida? And by the way, do you do only Florida or you go outside of Florida?
We'll go everywhere in the Sun Belt. I don't invest in California or New York or any really, really political states that might turn off my revenue stream. I mean, I don't want to get political, but it's dangerous. And I couldn't imagine if I woke up one day and not only was the economy in bad shape, but somebody said I'm not allowed to collect my sales revenue or anything like that. It's insane. So we stay out of those states, but I love Chattanooga. I love Tennessee. I love Florida. I love the mid-Atlantic. But anyway, do I see longevity in this space? Sure. I mean, it's already existed. All what's happening now is that Wall Street's putting a nice bow on it and packaging it so it can fit inside fund mandates and they can push cap rates down, and it's good for everybody in the business. But single family rentals have always been a thing. Now they're just trying to make them more efficient and deliver it as a thoughtful product instead of a side hustle by the average entrepreneur or investor. And I think it's going to evolve over time. It's really funny. Usually the larger the group with the more capital, the more visionary they speak. And they'll say things like they're making an experiential community that's supposed to bring people together. And it's all true. And it's so well thought out and everything's beautiful and thoughtful. And then you have, other individuals who are more merchant builders that are scrappy and pulling things together. So my point is, I think over time, there's going to be different types of communities out there. From the curb, they'll look the same maybe, but from the tenant's perspective and their shoes, they'll look much different and feel much different. The experience will be much different. So I think the exact form that plays out as being the best version of build to rent is to be determined. And I'm not going to ever get caught trying to make that type of prediction. But I will say that I think the asset class overall is certainly sustainable, certainly something that's going to continue on into the future. I'm hoping that my favorite product catches on over time, which seems to not fit in Wall Street's eyes just yet because it doesn't fit in the mandate perfectly, but mixed product. I love having townhomes or cottages and low-rise communities in the same, low-rise buildings in the same communities. That way you can kind of capture the tenant as they maybe grow throughout their career and the life cycle of the tenant, instead of having them from like 1 to 3 years, maybe have them 3 to 5, and they, start off in the studio, they end up in the 2-2, and then they eventually go to the townhome, and then they, maybe if you're a big enough developer, you sell them their first home too in another community in the same area. So, I love mixed product because the yield is there. I think the absorption risk is lower because you have a differentiator when you're looking at other communities next to you. But anyway, long-winded answer saying, yeah, I definitely think that the asset class will move forward and be sustainable. Do I know what form or what's going to be, considered standard in 5, 6, 7 years for this asset class? Not yet. And I just hope that people remain creative and keep providing cool opportunities to have some nuanced changes within the communities, such as like mixed product or other types of amenities.
Yeah, I appreciate that caller. Most developers do sort of single type, maybe a little bit of variance, but not what you just mentioned, simply because it's a lot less expensive to build. It's easier to execute in the short term, but on the long run, your strategy might have unique benefits that you have in your vision, and some other folks might be a little short-sighted. But it's a very cool idea to develop different mixed sort of, I guess, somebody as a starter, then upgrade, and then potentially move up at some as they
Great on the it's amazing on the entitlement side too. If you have, I have a site where one side of the plot is, abutting a residential neighborhood that's worried about height and all these other classic NIMBY issues, and you just tell them, hey, we're going to have townhomes along that entire border, so to you it's going to look like a community just like your own. Not that I buy into the fact that their property value would be damaged or anything else like that, but my point is you can sometimes satisfy the NIMBYism through a little bit of creativity, and if you build right, you can actually fetch a higher yield on those. And if you do it really well, you'll catch a wider demographic in your tenant base, and it's overall accretive if you can get the capital to understand the idea and not be so rigid. And that's why I end up usually working with more family offices or mid-market private equity or developers who have a large balance sheet, because they understand the deal for the unit economics, and they look at it as a long-term play with the ability to exit if they wanted to along the way.
Makes sense. So what's a typical exit strategy? Again, when the rates were low, a lot of refis were part of the equation. Refi was sort of a standard procedure. But in this environment, things are a little different. Is this typically built and then sell, or do you recapitalize upon completion? Just curious, kind of, what do you do with step 2 once you complete the project?
Yeah, it's definitely market dependent. We underwrite everything for a 10-year hold in case we get stuck holding the baby. And we usually end up looking at an exit somewhere between 5 and 7 years. But lately I've been seeing them kind of be pushed forward, just because that would be the only way to capture a strong IRR. But at the same time, in that same underwriting process, we'll look at it pushed, as a quick sale. But at the same time, we're like, if you don't sell in that period, then you're basically holding it for 7 years. So it's almost like that tweener isn't really the best return right now. Return metrics right now. But we really underwrite things for a long-term hold, and then if we can exit early, we will. I think those are just the best type of partners to have, because like I said in the beginning of this, you need to have staying power. You need to have the ability to believe in the market. We're not in major MSAs. We're looking in major MSAs. We just think that the value is not there right now. Anyway, my point is that when you're in major MSAs, people are happy to merchant build, happy to flip in and out. They're not necessarily focused on holding forever. Whereas in our markets, it's more of a, you become a part of that community, and you can maybe even buy up some more assets and have a substantial position in a community and really force appreciation over time.
Yeah, thank you for that color as well. It's funny what you said. you either flip or you refi and you keep for substantial amount of time, because you got to go through that whole exercise that prepare to hold it. So it's almost not necessarily binary, but if you're going to go through the hassle of actually preparing for long-term hold, you have that refi cost and the effort, and flip at that point doesn't make sense. So you either flip immediately or you just tighten the belt and you kind of sit on the project long enough where the value, I guess at least the market selection has been very strong. If these markets just appreciate naturally over the upcoming 5-10 years, then that long-term play makes better sense.
Yeah, and honestly, it's all case specific, and you're watching the asset, right? You got to be a good asset manager. So, if we achieve double the rent growth we thought we would have, maybe we do sell in year 4.5, whatever. I mean, you know what I mean? I can't get married. I get married to a market. You can't really get married to an asset within that market. I think you have to believe in the market itself and then understand what fits there best. And sometimes what you built may not fit in 7-8 years. And I don't even know what that's like because I haven't been in business that long. But my point is I couldn't imagine me doing something, doing something 8 or 9 years ago. And then today, demanding and doing my best to make sure that I stick to whatever I thought was going to happen 8 or 9 years ago or 5 or 6 years ago. It just isn't very pragmatic or practical in my opinion. So providing yourself, and that's really what I do from the beginning by buying land before it's entitled, providing myself with ultimate optionality is really key to being successful, and just making sure that, we take the route with either the least risk and the highest returns, or the right recipe of risk versus reward. And that's how we pursue every deal.
Yeah, that's a great philosophy. And there is no, as you said, there is no perfect timing to sell, but if the price is right, it kind of makes a lot of sense to move the asset. Anyway, appreciate all your wisdom. Thank you kindly for coming on the podcast. If folks wanted to get a hold of you, what's the best way to reach out?
Yeah, all my information is on my website, but just go email me at ray@southernwaterscapital.com. And yeah, looking forward to hearing from anybody.
Thank you kindly. Appreciate your wisdom, and thanks again for being a guest on the podcast.
Thank you.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to bigmikefund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.